Hello everyone, and welcome to this last seminar of the 2020-2021 series. We're going to take a couple of months break after this and hopefully come back in September. And for that, we actually need your help. Please submit your new work to us, to the call for papers that you can access through the link on our webpage. And I think the deadline for that is August 1st. And as usual, we will send those papers to a large group of folks who usually come to these seminars and ask them which of the papers they would like to see the most during the fall. And hopefully we'll have a nice, interesting slate of research in the fall months. And today, we're very happy to have Matt Ringgenberg with a very interesting study on the effects of the NYSE floor. Matt is asking us to hold our questions till he pauses a couple of times during his presentation. But of course, as usual, you are welcome to put your questions in the chat in the interim. And Matt's co-author, Dominik, may be here to answer those.
Dominik is here. So I think,
okay, cool.
I think he can help out on the chat in real time.
Great. So Matt, again, thank you so much for joining us today. And please go ahead.
Great. So thank you, Bjorn and Andre, for the invite, and thank you all for attending. So this is joint work with my colleague Jonathan and with Dominik, who is here on the line. I should say too, just to kind of preface my discussion, we've been presenting this a decent amount over the last month or two, and several of you, even some of the people on this call, have given us great feedback. It is not yet implemented. We have not ignored your feedback. We're working on it right now, but I'm presenting kind of the old version. So we do appreciate all the feedback, and we're working on it, and it'll all be in the next version, I promise, hopefully in the next month or so. But I'm going to start off and talk about floor trading. And since this is a microstructure seminar, I probably don't need to do my normal background, but just for fun, I'll do this, since Andre and I were kind of talking about the pictures here. You guys probably all know the history. The NYSE was founded under this buttonwood tree in 1792. And you know, things kind of evolved quickly. By the mid 1800s, they had a trading floor at 11 Wall Street. And so the thing I always tell my undergrads is the evening news, and I think many kind of regular people always have this outdated view of equity trading, and they tend to think of these kind of open outcry type pictures, right? In fact, you guys probably will still notice on the evening news, every time there's a big stock movement, there's this one particular guy that they always photograph because he has these great facial expressions standing on the floor of the NYSE. And so you still kind of get this perspective that floor trading is very much a big deal, when in fact, I would argue, this might be, you know, maybe not as sexy, but a much more accurate view of what exchanges look like today, right? So you should think of a bank of servers in New Jersey, right? Not an open outcry pit on the floor of 11 Wall Street. So very few exchanges still operate a trading floor. The one kind of really interesting exception is the NYSE. So the NYSE operates this hybrid system with both floor traders and electronic liquidity providers, with kind of a complicated combination of kind of interaction between them. And that's really what I want to investigate and speak to today. So of course, this is a very tough thing to talk about. You know, algorithms have been largely replacing humans, and this isn't even just, you know, a recent thing. It's been happening for quite a while now. And on the one hand, I'm tempted to kind of say, look, this is a revealed preference situation. The fact that algorithms are taking over tells me they're better than humans, right? That's why they're taking over. On the other hand, then this NYSE, the fact that these guys still have this floor kind of begs a different question. Well, if the algorithms truly are strictly better, why does the NYSE still have a floor? And so the question we really want to think about is, can floor traders still provide, you know, any benefit in modern financial markets? And like I said, this is obviously a tough thing to talk about because, you know, I don't get to randomly put some floor traders out there and see what happens, right? The NYSE chose this structure, and moreover, people choose where to trade. And so this creates all of these difficult endogeneity issues. And so the way we're going to address this is we are going to look at the closing of the NYSE floor, which happened as a result of COVID. And I'll walk you guys through the timeline of this and show you kind of all the details. But it's not a perfectly clean shock, but I think in the realm of empirical finance research, it's a pretty darn good shock. And so I'll show you the details on this. And again, many of you are much more experienced in the microstructure field than I am. So I'm not sure exactly what your prior was. But I will freely admit that what we found was probably the opposite of what I expected to find. So what do we find? We actually find, I think, very clear evidence that spreads, both quoted and effective, get worse when the NYSE floor closes relative to several different control groups. And the effects are pretty economically meaningful. We also look at, I see Joel is here, we also look at Hasbrook pricing errors. They get bigger. So, it's not just that liquidity degrades a little bit. It actually seems to have bite. It matters. And so then the last part of the paper that we're still working on, and this is where we've received a ton of excellent feedback lately that we're kind of poring over right now, is we're trying to understand the exact economic mechanism that could explain what we find. And so one of the things that I'm going to try to argue is that this is at least partially related to this idea of complexity. And so there is this kind of burgeoning literature, mostly in economics, but also in finance, trying to understand when algorithms can replace human beings effectively. And I'll give you just a real quick preview. A lot of the theory suggests that algorithms have this ability to replace human beings when they are performing routine tasks. And so then the question, of course, is liquidity provision routine or not? Well, our results would kind of suggest often they're not. And I'll show you kind of detailed results where we try to unpack this mechanism and really explore what's going on. But at a high level, what do our results say? Well, our results say humans tend to complement automation technology when tasks are not routine. So it's kind of consistent with some of these theory models. So that's the paper in the nutshell, kind of the high level preview. Again, since this is a microstructure seminar, I probably don't need to do anywhere near as much background as I normally do. So what I'm going to do is I'll give you just a real quick overview of the structure of equity trading in the US. And then I'll try to concentrate most of my time on the analysis, the identification strategy, and our results. And if I have time at the end, I will talk a little bit about some of the things we're working on now. As I said, we've gotten a lot of great feedback over the last 2 or 3 months, and so we're working on quite a bit of quite a few new analyses right now. Okay, so let me just give a quick overview on the structure and kind of recent changes that I think are at least relevant for what I'm going to talk about today. So in the old days, there were relatively few exchanges, right? So you had NYSE, you had NASDAQ, you had a few others. And again, I'm going to be a little imprecise, but just in the interest of kind of explaining a high level thing, for the most part, a stock listed on an exchange and traded on that exchange, right? So, if GE was listed on the NYSE, most action in GE occurred on the NYSE. In 2007, the SEC implemented regulation NMS. And so this, I think, was designed to encourage competition between trading venues. And as kind of as a result of this, we've seen a proliferation of trading venues, and there have been huge changes to the structure of equity markets in the US. And then I apologize, I have this shameless self-cite on a paper I wrote on fragmentation that examines this. But today, the US has more than a dozen exchanges and more than 50 electronic communication networks. So there's all sorts of different ways and places you can trade. And a huge portion, if not the majority of it, is electronic, right? So there are very few human beings, like think of that picture of the floor traders, who are still involved with this. And the other interesting thing that challenges or makes it difficult to examine floor trading on the NYSE is that all of these different trading venues, in a sense, have different characteristics. So I kind of think what's happened is you can almost think of like a hoteling market line of competition where, we all know if there, that hoteling line, if there were 2 exchanges, they would kind of slot in the middle and look pretty similar. But in a world where there are now 50, you have people who kind of cater to all these individual different traders. So all of these things have different order types, different characteristics, and that makes it difficult. I can't just compare liquidity on the NYSE to liquidity on NASDAQ and say differences are due to floor trading. No, there are lots of other differences, right? So that's the real challenge here. So I really want to explore does floor brokers, does floor trading still matter? And as I said, right, given all these different structures, it's not clear whether they matter. And the fact that algos have been replacing humans is at least one data point that says human beings are outdated, right? They can't do this. But as I said, there is this really cool paper by Autor and Dorn in AER, where they kind of examine labor market outcomes in a world where automation is introduced. And they kind of come up with this idea that basically tasks that are routine, where you're kind of just doing the same thing over and over and over and over again, are things, well, algorithms will just replace humans. They will be better than human beings, end of story, right? But on tasks where, there's not this routine nature, there's not this perfect repetition where you actually have to have some subjectivity involved, that's where they basically argue those are going to be the last areas where algorithms replace humans, right? Because it just turns out algorithms are not so good at replacing human beings' subjective judgment on these types of things. And so then in a sense, what I'm going to do is, at least, I gave you the preview of the results already, but I'm going to frame the analysis with this idea of basically, do you think liquidity provision is routine or is it more complicated, right? And I think that should kind of help your thinking about whether or not you think these floor traders should still be valuable in this modern world with algorithms. I will also say, as I said, there's kind of this burgeoning literature looking at algorithms in other contexts, and also even in finance. So there's a couple of papers looking at whether algos improve loan underwriting. And the interesting thing is actually some of the evidence suggests humans can still actually provide value here. So you see human intervention seems to actually improve outcomes. And then of course, there's a couple of papers that have looked at what happens when algos are introduced into bond markets and other financial markets. And you see, at least in some cases, evidence that they improve market quality. So I should also say too, there's a huge literature on just algorithmic trading, and I don't have time to go through it all. And also you should bug my co-author, Jonathan, if you want the overview of that, because he's much better versed in that than I am. And there's also quite a bit of papers that have looked at what happens when electronic trading is first introduced. Here, we're going to kind of have the mirror image, right? I'm going to look at what happens when I remove human beings. And then the last thing I should mention, there's this related paper by Hu and Murphy that's pretty interesting. And they kind of pitch it as looking at floor trading. I really pitch it as slightly different. I think they show pretty convincing evidence that the NYSE auction has in general worse market quality than NASDAQ closing auctions. And if you really dig apart their analyses and tables, most of it is focused on auction closing quality and not floor trading. They kind of compare all of NYSE to all of NASDAQ. And I think one difficulty there, of course, is NASDAQ stocks tend to be very different from NYSE stocks. And so I'll try to account for that in everything that I do in our presentation today. But if you haven't seen that, that's also a very interesting paper that looks at, I think, the differences in closing auction qualities and how that affects everything. Okay. But that was probably not a sufficient overview of the literature, but in the interest of timing, I'll kind of skip ahead. I guess, Andre, this is probably a pretty good time for a break. Should I just take one now? And does anyone have any questions?
Yeah, Matt, that'd be great. We just got a question in the chat from Carlos that I haven't had a chance to read yet. Carlos, okay. If you'd like to unmute yourself and just ask it, that'd be great.
Sure. Thank you very much for the presentation. And since we're now going to go into the analysis, I was just thinking, the dispute resolution piece, I'm thinking NASDAQ bungling, Facebook IPO, say, for example, and the litigation costs. Is it something that we should be having in the back of our minds as well, or we're focusing on just the kind of like the mechanics of it in some sense, and not so much when the mechanics fail and it's this called dispute resolution piece?
Yeah, that's an interesting question that I've not thought about. So again, I feel like my co-author Jonathan would be perfect for this, because if those of you who don't know Jonathan, not only is he a finance professor, but he's also a lawyer. So this would be like right up his alley. I mean, what I'll punt a little bit, and I think this is a little unfair, so I'll also go back and look at this more after the talk. But in a sense, what I'm going to try to do is isolate just the effects of having floor traders involved. So I think to the extent that there are any other differences between NYSE and NASDAQ, I'm going to try to get those things absorbed out. So I think, differences in dispute resolution, differences in litigation, those things should not be contaminating the analyses here, but I need to think more carefully about that question. I don't know if Dominik has anything to add. I'll let him kind of speak up too, but I'll write that down and look into it a little bit more. And then we can get back to you if I find anything interesting. Any other thoughts, questions before I kind of jump into the analysis and results?
Leon, I'm not sure if Dominik answered your question and you're good, but if you're not good yet, please unmute yourself.
Thank you. I'm good. Thanks.
All right.
All right. Good to hear from you, though, Leon. It's good to hear from you.
Great talk. Thank you.
Maybe a follow-up on Leon's question, which was about if some firms use both algorithms, electronic trading and floor trading. Do you have a list of the floor traders, and can you tell from that list if there are algorithmic traders or high-frequency traders who also employ floor traders?
Yeah, so this is one of the things we've heard more recently. And so someone suggested that we buy this data from the NYSE so that we could actually better measure different order types. So we could try to pin down, what type of actual trading was going on in individual stocks. So we just got this data like a week ago. And so that's on the list to start exploring. So that's not going to be in anything I've got in the paper today, but that's exciting stuff that I hope to have in the next version. Yeah, so we can drill down on that quite a bit more.
Matt, a quick question from me. Do you have any anecdotes maybe or any information on what the functions of the floor are these days? Is it blocks? Is it some sort of tough information that is difficult to process without human interaction? What do they do on the floor?
I mean, so the anecdotal evidence is that basically the floor traders specialize in working large orders. And so they're better able to kind of smooth out order flow and execute big trades without having big price impact. That's the claimed evidence, right? I will also say, and I'll show you evidence at the end of the talk of this, what you notice in the data is most floor trading action happens at the beginning of the day and the end of the day. And I think this is also going to be consistent with the Sotor and Dorn idea of routine versus complex liquidity provision, because basically what you see is in the middle of the day, there's not a lot of surprise information coming out anymore. Things start chugging along in a routine way. And that's where I'll show you some evidence that it looks like floor traders aren't doing much and don't matter, right? But at the beginning of the day and the end of the day, that's where you see most of the trading from floor traders. Yeah. Okay. And I think, Vidisha had a question too. Oh, and yeah, she had a list of the floor traders. So yeah, that's stuff we're working on.
Yeah, can I just quickly jump in?
Yep, go for it.
Yeah, so I actually have talked to a couple of them. There's a Baycrest. I've sent you the link, Matt, for the floor brokers.
Perfect.
And I've talked to Baycrest partners, and they actually confirmed that they are not prop traders. They are just directing their customer orders, sometimes through the floor. So there are the contact information for all these, each person, and they're quite accessible by phone. So you can actually call them one by one and talk to them.
That's awesome. I appreciate it, Vidisha. Thank you.
Sure.
So we'll definitely do that. Cool. All right. If there are no other questions, then I'll jump in and kind of tell you a little bit about what we're going to do. So, the data is pretty standard stuff. So we're going to look at all U.S. equities with share codes 10 and 11, and then a couple of standard filters. We're going to look at daily data with a pretty narrow window around the shock for identification reasons. But I'll show you kind of various subsample cuts too, where we vary those assumptions and we find similar results. And then we are going to pull a lot of our measures from the Wharton intraday indicators data set, so that hopefully we avoid computation errors constructing these variables ourselves. So these are we'll have proportional quoted spreads and proportional effective spreads. And then in case I failed to mention this later, one of the comments we've received recently is someone wanted to know whether the fact that we show that spreads increase was a result of the denominator decreasing, right? So stock prices fall as a result of COVID in our sample. And so you might expect that maybe the fact that spreads get worse is actually a denominator effect. So we also look at dollar spreads now and find the same results, right? So I'll show you evidence on proportional spreads, but dollar spreads look similar. And then we are going to calculate some of these measures as well at a high frequency level using the Holden and Jacobson code. And then we're also going to have Hasbrouck pricing errors, right? So pretty standard stuff. Let me give you the timeline then of what goes on here. So you guys, I don't want to traumatize anyone, but if you guys remember back to what happened last spring, right? So this thing starts filtering out, right? We start hearing about COVID. I remember sitting around in the faculty lunchroom here in February, kind of looking at the writing on the wall and realizing that this thing was going to spread around the world. And if you kind of remember, by early to mid-March, we really started to see evidence of it. And so what ends up happening here then is on Wednesday, March 18th, the first NYSE floor trader tests positive for COVID-19. And so then the interesting thing is you start seeing instantly some floor traders not coming in, and they officially announce that the floor will close Monday, March 23rd. Right? But you actually do see evidence like right away on March 18th that behavior starts changing. So Monday, March 23rd, floor trading is closed. But here's the I think this is why this is such an interesting setup. What happens is DMMs, if they used to operate on the floor, still operate. They can just only do the electronic aspect, right? So really the closure of the floor has really only changed two things, right? There's no longer human interaction face-to-face, and there's a special order type that only floor traders can use called the D order. There's no D orders, right? So that's really what's interesting about this shock is we shut down all these other channels, and the only things that change are these two things, okay? What's also really interesting is over time, they have kind of partially reopened the exchange in ways that allow us to kind of zero in more on the mechanism. So on May 26th of 2020, floor trading partially resumed, but the interesting thing is they still kept all of these social distancing measures in place. So in particular, what happens now is on May 26th, you start seeing these D orders again, but human interaction is still limited. There's no open outcry, and if I want to talk to Bjorn, I still have to stand 6 feet away from him, right? So I think you can imagine that the flow of information and that human interaction is still not back. As of mid-May of this year, so literally like a couple weeks ago, they have now gotten back to the point where it's almost back to complete normal. If you're fully vaccinated, you can kind of go on the floor and have human interaction, right? But that is only in the very last few weeks, right? So it took a long time for that to happen. So what do we want to do? I want to understand if floor trading matters for market quality. Of course, as I said, there's all sorts of endogeneity issues here. Certain stocks or certain trade types may be more likely to execute via floor breakers because of firm characteristics, because of trade characteristics, because of the liquidity. So all of those things are jointly determined, which makes it very difficult. I can't just compare the liquidity of floor trading executed trades versus the liquidity of not floor trading executed trades. So what we're going to do is use a difference in difference methodology to try to isolate the impact of floor traders. In the interest of time, I'm not going to go through this at an excruciatingly detailed level. But if you're curious, in the paper, we try to be very, very specific about this. And so in particular, what we do is we write out kind of a model of what are all the possible confounding variables that could make this challenging. And then I show you how our difference in difference specification knocks out the confounders, okay? But basically what we're gonna do is a difference in difference analysis before the closure of the floor versus after for a treatment group relative to a control group. And so of course, then the natural question you guys might have is, what is the control group, right? And so what we're gonna do is we're gonna have two different control groups with two completely different sets of identifying assumptions. Again, I'm not going to try to convince you guys that we are the first perfect difference in differences paper in all of human history, right? We're going to make identifying assumptions. They're assumptions, but I think they're pretty reasonable. And if you don't like the assumptions in one of our control groups, I'll show you another control group, And the interesting thing is, with a completely different set of identifying assumptions, we're going to find almost identical results. So that's kind of one of the other things that I think is pretty comforting here. So what are the two control groups? Well, we're going to look at NYSE listed stocks as the treatment group before versus after this floor closure. One control group is I'm going to compare them to a matched sample of NASDAQ listed stocks that are matched on price, volume, market cap, and industry. So these are stocks, and I can show you some evidence on this, that really, at least ex ante on observables, look identical. And again, I do think this match sample approach is important here because we all know NYSE and NASDAQ stocks are different in a lot of ways, right? NASDAQ stocks tend to be a little smaller, a little bit more tech heavy. And if you think about why this matters in this situation, well, I mean, I guess I should, pose it to you guys this way. Do you think the pandemic differentially affected tech stocks relative to blue chip stocks? I would argue yes, right? And so that makes it very difficult. You can't just compare all NYSE stocks and all NASDAQ stocks, right? Because the economy was differentially affecting these potentially. So that's why we do this match sample. Of course, you may still worry, right? Match samples match on observables. There may still be unobservable differences. So you might still worry about an omitted variable bias. So I'm going to do a completely different control group that I think has a completely different set of identifying assumptions. What I'll do is I will compare NYSE listed stocks trading on the NYSE to trading in those exact same stocks off the NYSE, right? So here, so in the first case, think about me comparing, GE to a big conglomerate traded on NASDAQ. In the second case, think about me comparing trading in GE that's executed on the NYSE to trading in GE that's executed on the same day and same everything, except it's executed on BATS or NASDAQ, right? And we're going to look for differentials in liquidity there before versus after the closing of the NYSE floor. Okay, so the identifying assumptions here, of course, is parallel trends. I'll show you some pictures that I think they look pretty good. But I do always like to kind of say, what are the things that could screw up my inference here? So what are the big concerns? Well, one thing you should be worried about is, as I said, if a shock differentially affected NASDAQ firms relative to NYSE firms around the closure of the floor, you could get kind of spurious inferences. Of course, I think you have to worry the economy differentially affected tech stocks versus blue chip stocks. It does look like, though, in our match sample where I match on industry, there's not an issue here. Okay, so it looks like our matching takes care of this. To the best of my knowledge, there are no other shocks that would contaminate this. But you still, you should think about if there are other shocks. When I look at NYSE trading on NYSE versus off NYSE, I think the identifying assumptions are much, much weaker. Basically, the principal issue I would be worried about in that analysis is violations of the stable unit treatment value assumption. So, I mean, I think by its definition, we have firm times date fixed effects in this specification. So even if there are time varying shocks that affect these firms, this specification absorbs it. There really can't be an omitted variable. The thing that I think you could be worried about is if traders differentially adjusted their liquidity provision off the NYSE versus on the NYSE at the exact same time as the floor was closed, that could confound the influence. However, I think that unlikely is going to lead to an attenuation bias, which should work against us. But again, I'll show you some pictures kind of supporting the identifying assumptions. Okay, so the details of all that diff and diff stuff are in the paper. I don't have a ton of time here. So let me kind of start showing you some results, and then I can pause again and maybe take some questions after I've shown you some of the high level results. So formally, we're going to look at difference regressions. And for each of these analyses, I'm going to show you two tables. One where the control group is NASDAQ, one where the control group is NYSE. Okay, and you'll see the results look pretty similar for both. So the first thing I'm going to look at is how did effective spreads, proportional effective spreads, change when the floor was closed for NYSE stocks relative to NASDAQ stocks. And so this coefficient untreated times after gives you the difference in difference result. And in basically across these different specifications, we consistently have a result that proportional effective spreads increased by about 9 basis points. And the unconditional mean in our sample is something like 18. It's a little higher than normal because if you guys remember, as the pandemic was happening, people got stressed out and liquidity got worse, right? But you see a pretty big change. And this ends up being then about a 50% increase in proportional effective spreads for NYSE stocks relative to NASDAQ stocks, right? The other thing I want to point out is there's this great paper by Emily Oster where she kind of provides ways to assess whether or not your results are susceptible to an omitted variable bias. And what she basically says is, as you vary control variables and as you vary different fixed effects, if your treatment effect remains incredibly stable, that gives you evidence that your identifying assumptions hold, and it's very unlikely that a correlated omitted variable would change your result. And so again, one thing I love in all of our tables, as I completely vary the specification, the treatment effect changes very little, right? So that again kind of supports the identifying assumptions. Let me then show you the NYSE control group. What do you see in the NYSE control group? Basically, the effects are a little bit economically smaller, but otherwise it's the exact same story. So here we see it's about an 11% increase in proportional effective spreads for trading in GE on the NYSE versus trading in GE on the same day off the NYSE, right? And so again, to me, that's pretty convincing evidence because you see within the same firm and day, trades on the NYSE get worse execution than trades off the NYSE relative to before the floor was closed, okay? Let me then show you one more table and I'll pause for questions. Here is evidence of the parallel trends analysis. Again, so any of you who've ever run a difference in difference analysis knows they're noisy. You never get perfection. This is maybe the cleanest diff and diff parallel trends picture I've ever been involved with. So I was pretty excited to see this. You know, you can see both NASDAQ and NYSE spreads kind of bounce around a little bit. As the pandemic hits, of course, they get quite a bit larger, but they seem to generally follow a very similar trend for both NYSE and NASDAQ stocks until basically the floor is closed. So this first black line is actually the date that the first guy tested positive for COVID. And so you can see there starts being a disruption right there. But the main disruption, at least in this picture, occurs once the floor is officially closed. Okay, so with that, then I guess let me pause for questions, and if anyone has any other questions, I'm happy to ask. I think Dominik has answered a bunch in the chat.
Yeah, so there is a question from Peter and Bidisha, I think, about strategic complementarity effects that Dominik said you should answer. Peter, would you like to say your question?
Yeah, thank you. Yeah, I was just wondering about this control group. So it is, as you say, an imperfect business is one. So maybe you can just explain it better. I get the understanding that if you remove the floor, then all markets are affected, and when traders seeking liquidity will go elsewhere. Liquidity bounces around. I mean, how do you really control for these things with difference in difference?
Yeah, so this to me gets back to that stable unit treatment value assumption, right? And so the idea here is like, if I want to understand whether sugar pills make people happier, I give Bjorn a sugar pill and I give Andre a pill that has nothing. And I want to see whether Bjorn gets happier. The concern would be if Bjorn gets happier, it makes Andre smile and he gets happier, and then everything's screwed up, right? So that's the stable unit treatment value assumption, that there are kind of these spillover effects between the treatment and control groups. So I think here, to me, one of the concerns is, yes, if I suspend floor trading on the NYSE, will liquidity providers on other market centers adjust their algorithms to account for that specific fact? I think one thing that works in our favor here is the abruptness of the change, right? So this thing happens so fast. Basically, you've got a couple days notice and it's done. And so to me, I think it's less likely the algorithms would at least quickly adjust to that. You might also expect, though, that over time, the algorithms would adjust And you would start to then see basically the treatment effect dissipate. I do see a little bit of evidence that the treatment effect dissipates at longer horizons, but that also corresponds with the partial reopening of the floor. And so it makes it challenging to disentangle whether it's really a violation of the stable unit treatment value assumption, or it's the fact that the exchange partially reopened. What we are doing right now is we're kind of hoping that with this new data on order types and some of these other things that we'll be able to drill down and say more about, why exactly we found effects in the first place and why they dissipate later on. And that might at least indirectly speak to this more. But again, I think what I try to just do is say, look, we make identifying assumptions. I think they're better than most, but they're assumptions, and I'll show you evidence that I think they hold, but they're assumptions, right?
Good, thank you for clarity on it.
Yeah, other questions from the audience? I think, Carlos, do you have another one?
Yeah, I had a very quick follow-up on that one. On the intensity of treatment, you said that there's some, as it reopens, the gap disappears. Can you elaborate a little bit on that? Are we talking completely, or?
Yeah, I'll show you the table at the end. It partially, but not fully reverses, right? So I think that again suggests that, to me, this human interaction does matter. And it also suggests that it's not all just violations of stable unit treatment value assumptions, because the algorithms by that point have had a lot of time to adjust, and we still find a differential, right? But I'll show you that result in like 6 or 7 slides.
No, I guess I was thinking you didn't see any scarring, right? Something that because of this change, something fundamentally changed going forward.
Yeah, so that's a cool question. And my hope is, and Dominik might be really mad for me saying this, just in the last few weeks, we may now have the ability to test whether there's any permanent effect, because the exchange is finally almost back to normal. I mean, it's not quite back to normal. But I think we can try to check whether or not there's any differential remaining today. If there's not, then I would say then there's no scarring, right? There's no permanent effects. But I haven't looked at that yet, because that literally just happened in the last few weeks. Okay, so I think let me show you some more results since I'm a little low on time. Effective spreads get worse. I will also note, just my colleague Elena Asparova has kind of a cool lab experiment that is actually very consistent with this. What they do is they run this lab experiment where humans can trade manually or use algorithms. And what they actually find is that effective spreads are best when humans participate and use algos, right? When both are going on. And that's actually, exactly consistent with what we find. But that's effective spreads. Of course, you might also wonder, are liquidity providers behaving differently? So let me show you quoted spreads. And what you'll see, again, I'll show you NASDAQ table first, then NYSE control group second. You find basically the exact same results all the way through. So basically, again, treated times after is positive and statistically significant. This coefficient of 2 implies about a 7% expansion in quoted spreads relative to the unconditional mean. Again, I just love that as we vary control variables and fixed effect specifications, the coefficient remains remarkably stable. So that all kind of supports the identifying assumptions. When I switch over and use the NYSE stocks as a control group for themselves, again, you find almost the exact same results. Here, the effect is even a little bit bigger. You can think about these coefficients of 11 or 10 as being like a 30-some% increase in quoted spreads relative to the unconditional mean. So again, I think I've shown you different effective spreads, quoted spreads, different control groups. You find the exact same results. As I vary controls, as I vary fixed effects, the results are pretty stable. And then again, here's the parallel trends graph, more of the same, right? Again, you just see NYSE, I think this is exactly what I would expect. Trades of NYSE stocks on the NYSE versus off the NYSE tend to have the exact same quoted spreads, right? It's a competitive market, except for once the floor closes. Then you start to see differentials between these guys, right? So the parallel trends assumption looks pretty good. Okay, so what, right? Does this matter? Do we care that spreads have gotten worse? Well, I generally think that, or at least I like to believe that one of the reasons we as researchers often think about liquidity is it has important implications for things like price efficiency, which could affect the allocation of capital in the real economy. And so we're going to look at Hasbro pricing errors next. Again, I'll show you NASDAQ control group first, NYSE control group second. And what do you see? More of exactly the same. So here we see about a 6% increase in Hasbro pricing errors for treated stocks relative to control stocks on the NASDAQ. Again, the effects are remarkably stable across different specifications. When I go to the NYSE control group, exact same thing. Again, you see the effects are a little bit smaller, but there is a 2% increase in pricing errors for trading in GE on the NYSE relative to trading in GE on, BATS and NASDAQ and all the other market venues, right? So again, different identifying assumptions, different specifications, exact same results, which I find pretty comforting all the way through. Okay, so then I don't have a ton of time left. One of the last things we do is, and this is the area we are kind of digging into the most right now in response to a lot of great feedback we've received, is we're trying to figure out more about the economic mechanism. And so what I'll show you now is just the tip of the iceberg. We've gotten a lot of great ideas from people that I hope will be in the next version of the paper. But what we've done now is we've tried to think about this complexity idea from that O'Toole and Dorn paper. And so what we're going to do is a very simple thing. I am going to just break our analyses instead of into the daily level. I'm going to look at half-hour intervals throughout the trading day. And what do you see? Basically, all of our results are concentrated in the hours after the opening. And here they're not super statistically significant, but the magnitudes are similar right at the last hour of the day, right? Last half hour of the day. And if you think about this, again, I think this makes sense from an economic mechanism perspective. So imagine you are a floor trader. Overnight, all sorts of news comes out about firms. When is it most challenging for anyone, an algorithm or a human, to kind of anticipate what the intersection of supply and demand is really going to look like? Well, I think opening up at the beginning of the day is when it is going to be most difficult to understand how all this overnight news has impacted liquidity demand and liquidity supply. And so that's where you see that floor traders matter, because that's when liquidity provision is least routine. In the middle of the day, when markets are just kind of chugging along like normal and firms are very unlikely to release significant information, you see actually floor traders don't matter a bit. So in the middle of the day, we find precise zero estimates that floor trading just doesn't do anything. It's really at the beginning of the day and a little bit at the end of the day. The other thing we'll do is we construct this measure of complexity. And again, it's a proxy variable, so it's not perfect, but we try to measure complexity as basically 1 minus the R squared of a regression of a stock's returns on the market returns. And so think about this as trying to say, how much variation in a firm's stock returns are due to idiosyncratic news that's impossible to anticipate, right? And that's kind of a measure of complexity. And what we see is if we interact complexity with our difference in difference treatment times after variable, you find it loads positively and statistically significantly. So again, basically what this suggests is that spread effect that we've found is concentrated in high complex times, right? And so it does seem like the complexity of the liquidity provision has something to do with the effects we're finding. Okay, so then the last thing I'll show you in the main results before I show you a little on reopening is we also look at measures of auction closing, because again, you might think that the closure is also a time when liquidity provision is more complicated. And so here what we're going to do is construct this measure of auction deviation. So basically, this is the difference between the auction price and the last continuous trading price. So you can kind of see how different the auction is from continuous trading. And what again you see is after the floor, you see basically at both the opening and closing auction, an increase in this deviation measure. So it really does seem like, again, at the opening and closing, that's where these results are biggest, right? When things are most complex. Okay, so I am almost out of time. Let me show you just, Carlos kind of asked to see this. So the floor has partially reopened. And I think we've got pretty strong evidence that I've shown you so far that floor traders do matter, especially when liquidity provision is more complex. So we've started trying to unpack the mechanism more. And one of the things we've looked at is the reopening that happened in May of 2020. And what I want to stress is it was a partial reopening, right? So what ends up happening is they allow deorders, but they don't go back to open outcry. They don't go back to, Bjorn and Andre and I standing at the water cooler talking face to face. So it really is still allowing, or preventing some of this human interaction from happening. And so what do you see? Well, basically when the floor partially reopened in May 26th of 2020, we see a partial reversal of all the effects I showed you. But if you actually look, the magnitudes are very much a partial reversal. We don't see a full reversal. And so again, that suggests, I think, that something about that human interaction is actually valuable. And so even when you allow the deorders back, the fact that human interaction was still constrained prevented a full reversal of the effects. As I said, they've gotten even closer to a reopening in the last couple of weeks. Since we haven't had data, we haven't been able to explore that, but it's possible you'll see a full reaction or a full reversal now. Okay, so let me conclude and then I'll take some more questions if people have them. So at a high level, I guess I don't know what your prior was. I thought almost by revealed preference that algorithms were replacing humans because they were better than humans. But there's this theory literature that suggests that algos may not be able to replace humans when things are complex. And that's kind of exactly what we find. So after the removal of floor trading, both quoted and effective spreads are larger and prices are less efficient. And it does seem like this is related to the idea of complexity, right? Consistent with the theory. So I guess I would kind of conclude with it's possible humans do still have some benefit, especially in non-routine tasks. Okay, and so with that, then let me open it up to questions, comments, criticisms. If people have thoughts, I'm happy to hear them.
Thank you.
Oh, you're muted again, Andre.
I'm sorry. I thought I figured the Zoom thing out over the past year, but clearly I haven't. Matt, thank you so much for the presentation. And Dominik, thank you for answering the questions in the chat. So we owe Leon an answer because he raised his hand quite a bit earlier and then we never got to him. Leon, go ahead.
Thank you, Andre. Thank you, Matt. Great talk. It's very informative, very exciting results. So I have a kind of a question that's related to the question I asked. Also, you alluded to the answer in the middle of your talk. So it's great to see that humans are still useful. We can still do something with so many advanced machines. So very naive interpretation of that the result is kind of we treat humans and machines equally. It's just the same thing. If you reduce the number of market makers, we interpret those all of them as market makers. So it's kind of easier to the direct result is you can reduce the kind of liquidity provision so that you have all the results like higher liquidity, higher spread, all these kind of things. So I know that you already kind of thought about this and you think about the deeper, so what's the additional effect? So one natural direction is about the information. So you also talk about this this might be related to kind of complexity. I still want to know so exactly at what scenarios? You mean complexity is still kind of very elusive. So what scenario situations people kind of better? So even if you think about you mentioned at the very beginning, so the task might not be very routine. Closing day, open day, this kind of things. I think even for the information, we may think about the different types of information. For example, if you think about a merger and acquisition, that might be big news, that might be new. So that people might be kind of have a better ability of doing that because it's kind of new information. If it's about the trading patterns, so maybe it's better for algorithm. So I'm thinking about exactly on what scenarios people better. So I can learn something more, and in the future I can still survive. I want to go that direction. So that's my broad question.
Yeah, I mean, I do agree. I mean, that's kind of one of the things we're trying to work on more now is the mechanism to try to understand exactly why this result is there. And my intuition is that things like the arrival of information probably are related to complexity. We haven't tested that. We might be able to do that. I mean, we could get data on things like overnight news maybe and see whether or not floor traders matter more after overnight news or something like that. That's an interesting idea that we haven't done. But I also think, and I don't know, maybe this is partly what you were getting at too, and I think some of the comments in the chat are getting at too. One other thing I've wondered about is there are systematic differences between the way the NYSE is set up relative to the way somewhere like NASDAQ is set up. And, you know, one possibility is almost they designed the NYSE to make floor traders useful, right? So you might think that these floor traders tended to be old seat holders at the NYSE. They may have wanted to make it so that they were useful. But again, to me, that answer kind of, you wouldn't expect that to be a permanent effect, right? As floor traders removed, I think this gets back to some of the other things people have said, like Peter, you might expect then that algorithms would basically be able to adjust and compensate such that floor traders no longer mattered, right? And we kind of don't see evidence of that. So to me, it gets back to that idea that there is something that these human beings can do that cannot be automated, at least with technology so far. And so I think, Leanne, I mean, maybe I can shoot you an email and we can talk about this more, but we are trying to think of more tests to do on this to narrow it down, because I do think this is super interesting. But we're going to try to explore the information channel more.
Thank you.
If you have other ideas, I'd love to hear.
Thanks.
Yeah.
Bjorn?
Yes, speaking of the mechanism, I was trying to understand the quoted spread result. That spreads go up when the floor traders are no longer there. That somehow indicates that the liquidity suppliers like to be in the market where the floor traders are. They quote tighter spreads when there are floor traders around. So there must be something with the floor traders flows, perhaps, that makes it attractive, somehow indicating that the floor traders represent uninformed orders. So maybe,
well,
maybe
I actually think, I mean, one of the things I suspect goes on is that, you know, order types are not randomly assigned to floor traders versus algos, right? There is a choice that's going on. And it may be that there are these natural liquidity providers for different types of trades. So the human beings are the natural liquidity providers for the types of trades they did prior to the floor being closed. And the floor traders were the natural liquidity providers for the types of trades they did, you know, prior to the floor being closed. And once you forced the floor closed, you suddenly had algos doing liquidity provision in things that was not their natural thing, right? So they were forced to do trades in different types of situations, and they were less comfortable with that. So spreads get quoted larger, right? That's one kind of thought I've had on that, right? Is that there was a natural segmentation. People chose when to provide liquidity on the floor versus algos, and afterwards that choice was no longer available, and so you get kind of this pooling where everyone has to increase spreads. Right?
Somehow, if there is a segment of market makers who cater for these floor traders orders, I would think that they quote wider spreads than the NBBO. The NBBO is probably dominated by HFTs who specialize in small trade sizes. And if anyone specializes in the floor traders, that would be larger sizes.
Yeah, agreed.
Maybe this is something that could be explored with the new data set that you got your hands on.
Yeah, I mean, that is exactly one of the things we're trying to dig into more. So now that we have this cool data, we can actually see more about order types and properties of individual trades and try to understand more about exactly what changed and what didn't change after the floor was closed. So, I mean, we literally just got this data like a week or two ago, and I'm sure Dominik can say more about it than I can, but if I'm not mistaken, it's like measured in terabytes. So it's going to take us a little bit of time to kind of dig through it and really understand it. But I think there's a wealth of cool stuff we can do in that data. Yeah.
Thanks.
Matt, so in the chat, Sophie is suggesting that one alternative measure of complexity could be looking in the cross section of firms in terms of how they may have been affected by COVID. I'm not sure
That's
if you've thought
interesting.
about that.
Yeah, that's an interesting idea. So you'd get some variation in that some stocks, maybe it was easier to understand how the shock affected you versus other stocks, it was harder to understand how the shock affected you. I need to think about that more. That's an interesting idea. I guess, at first glance, my concern is that that would also be correlated with differential impacts from the shock, right? And so there may be, there's differences in fundamentals, not just differences in uncertainty about fundamentals. And that would be a challenge for us from an identification standpoint. But let me think about that one more. Maybe there is something we can do there to try to tease that out. I think, yeah, if people have other ideas on how to measure complexity, I think that would be helpful. Yeah.
There's also a discussion in the chat between Pete and Dominik. I think it may be useful to bring it out for everybody to hear, but I think what they're discussing there is that if the floor is doing a lot of block trading and then the floor shuts down and these blocks have to go somewhere, they have to somehow get executed, they may start punching through the book more. And that could potentially be the, let's say, effective spreads that you're observing.
Yep.
I'm not sure if there is a very clean way to test for that, maybe through trade sizes. Have you looked at trade sizes by any chance?
No, I don't think we have. Maybe Dominik can correct me if I'm wrong, but I don't think we have looked too much at trade size. And that seems like something that's interesting. So we can add that to the to-do list. Yeah, I mean, that's an interesting idea. I mean, I think, Dominik answered some of these in the chat here too. I mean, one of the things we've also done is we've excluded midpoint trades and we find basically the exact same results. So that maybe indirectly speaks to this a little bit, but we could do more. And like I said, that's one of the things we're doing now is just trying to unpack the mechanism more to really understand exactly what's going on. But we haven't done that yet.
Folks, maybe instead of chat, we could switch to verbal discussion to sort of speed this up. Matt, while we're waiting for others to raise their hands, I have another quick question. So in one of your control samples is NASDAQ stocks. And I came in under the assumption that NASDAQ stocks actually trade on the NYSE too, pretty much at the same level as the NYSE stocks trade on the NYSE. So are you implying, and if so, is there actually something you can tell us about it, that when it comes to floor trading, they don't do much NASDAQ stocks there, and it's mostly the NYSE stocks?
Yes, so this is a great point. So let me just kind of rephrase this. So, when we compare NYSE trading to NASDAQ stocks, one concern you might have is if the NASDAQ stocks traded on the NYSE just the same as the NYSE stocks, then they should also be affected by this shock in the same way. Now, we've talked with the NYSE. The anecdotal evidence we've gotten from them is stocks that are not listed on the NYSE very, very rarely trade through the floor. So they are very likely to trade through the algos, but almost never trade or very rarely trade through the floor. Now, that's an anecdote, and we use that to motivate our tests. In the new data, we can see order types, and so we're no longer going to assume that. We're going to show you data on it. But I don't have that yet. But I think we're of the opinion, and at least everything we've been told, is that if you are Tesla, I think that's a NASDAQ stock, it is very unlikely you ever traded on the floor of the NYSE, or it happens very rarely. It's a small portion of your overall trading. So I don't think that's an issue for us, but with the new data, we can actually look at it. And so I'll tell you more once we unpack the new data.
Yeah, it looks like you have a lot of exciting analyses waiting to be done. One other thing it kind of came to mind right away is the decomposition of the effective spread into the inventory component. Well,
actually, that is a great one too, and that one I think we've already done. Dominik, do you? Dominik will remember the results better than I do, but we have decomposed the spread already, and I think we have those results. Maybe I don't know if Dominik is willing to speak on the fly about that, but But for sure it'll be in the next version of the paper. I just don't remember exactly what it was. Yeah, I mean, there was some noisy stuff in there, I think, but I think we did decompose the spread to try to understand exactly what was going on. Yeah,
I think Dominik is very busy answering questions in the chat still, so he may not have heard us. All right, folks, unless there are more questions, we are at the top of the hour. And Matt, I'm going to thank you again so much for stopping by at the end of June, and for the very interesting talk. And thank you all.
Thank you all.
And thank you all for joining us. We hope that everybody has a great summer or whatever season it is where you live. And we hope to see everybody in September.
Great. Thanks, everyone. And hopefully we can all get together in person by fall, but we'll see, right?
Oh, yes.
Thanks, everyone.
All right. Bye-bye.